All right, let's unpack this. Today we're diving into a company, well, whose tech probably touched your wallet recently. Fiserv, Inc. They're a huge player in global payments, financial services tech. You know the type. Our job today is to give you the highlights, the essential moves from their Q3 2025 quarterly report. That's the 10Q covering everything through September 30th.
Yeah, and this deep dive, it's really about getting under the hood of Fiserv. You've got this aggressive expansion on one side, the merchant side, and then the more stable, high-margin financial side on the other. How they're using their capital, that's key.
Exactly. We're going to walk you through the big financial shifts, how they're allocating capital pretty aggressively, I might add, and the whole strategic reshaping, the M&A, new stuff they're launching, all define their year so far. Let's maybe start with the headline numbers. 9 months ending September 30, 2025.
Sure. The top line, revenue growth, it looks steady. Total revenue is up 5%,
5%. Oh,
which
yeah.
brought it to $15.9 billion.
5% revenue growth is, well, it's solid. But reading through the 10Q, it feels like the real story is lower down, bottom line, margin shifts.
Absolutely. That 5% top-line growth, it powered a much bigger jump, 22%, in net income attributable to Fiserv, Inc. That hit $2.669 billion.
Wow, okay.
And partly thanks to their capital strategy, which we'll definitely get into, diluted EPS landed at $4.83. So the real question is, where is that performance, that operational strength actually coming from?
Yeah, perfect question. Because Fiserv operates in basically two big buckets, right? Merchant solutions and financial solutions, very different worlds. Merchant is the POS systems, the card processing. Financial is more the core banking tech, digital tools for banks, credit unions. So which one drove the growth this year?
Okay, so the merchant segment was definitely the growth engine, no doubt about it. But, and this is important, there's a trade-off happening with profitability there.
Okay, let's break that down. Walk us through the merchant segment first.
Right. So merchant showed stronger top-line growth. Revenue expanded by 7% year-to-date.
7%.
Totaling $7.6 billion. Now, the story within that is really dominated by their small business unit. That single unit contributed 5% of the segment's growth. And it all comes down to one thing, the Clover POS platform.
Clover. Right. For anyone maybe less familiar, just how central is Clover to Fiserv now?
Oh, it's everything on that side. It's their flagship smart point of sale. Think cash register meets payment infrastructure, meets business management tools. The merchant segment success that's measured by Clover's growth, more payment volume through it, more businesses using the value-added services like inventory tools, analytics. That's really what they're betting the future on.
Okay. And the other side, financial solutions, the sort of stable institutional clients.
That segment grew too, but more moderately.
Right.
3% year-to-date, reached $7.3 billion.
Slower growth there.
Yeah, and the growth wasn't really about volume in the same way. It was driven by selling more sophisticated, higher-margin products, specifically things like data and analytics sales, software license revenue, particularly in their digital payments and issuing businesses.
So fast growth in merchant, slower but maybe higher quality growth in financial. But growth rate isn't profit, right?
Right.
That's where the nuance is. If merchant's growing faster, are the margins better there too?
And this is where you see the, let's call it, strategic tension inside the company. Because actually, no. If you look at operating margins year to date, the slower growing financial segment, its operating margin actually increased, went up 50 basis points
50 basis points up.
to a pretty impressive 46.3%.
Wow, nearly 50% margin. That suggests they're selling, well, very valuable stuff with low variable costs.
Exactly. Pure software licenses, data services, you're not dealing with the physical transaction costs or huge sales commissions in the same way. It's back-end infrastructure, the profit capture is high, and it's steady.
Okay, now contrast that with the high-growth merchant segment.
Right. Despite leading on revenue growth, the merchant segment saw its operating margin decline, dropped 90 basis points year-to-date.
90 points, down to
35.3%.
Okay, 90 basis points is a noticeable dip. Why is that growth suddenly getting more expensive on the merchant side? What's eating into the margin?
Well, it's mainly two things, according to the filing. First, just higher data processing costs. More volume means higher variable expense. That makes sense.
Sure.
But the bigger factor seems to be higher residual payments. These are going out to their channel partners.
Residual payments. Explain those in this context. What are they?
Think of them as commissions, basically, or ongoing revenue shares. They're paid to the network of independent sales agents and partners who sign up the clients, especially those small businesses using Clover.
Oh, okay.
So if Fiserv is pushing hard to get that 7% growth, signing up lots of new merchants, they're having to pay out significantly higher commissions to those partners. They're essentially, well, buying market share, even if it costs a bit on the margin side for now.
Buying share, maybe hoping the lifetime value pans out. Okay, here's where it gets really interesting. Let's look at how they're spending capital strategically to fuel this. Because they haven't just relied on organic growth. They went on quite the shopping spree this year.
Oh, absolutely aggressive.
Yeah.
Totaled $397 million in net purchase price just in the first 9 months. And the strategy was super focused. It was about geographic expansion and adding vertical specialization, all aimed at making Clover, indispensable.
Okay, give us some examples. What kind of buys expand that Clover footprint?
All right, so they bought CCV Group BV, that's in the Netherlands. Clear move to push Clover into Europe. They grabbed Pinch Payments. That gives them an immediate presence in the Asia-Pacific region.
APAC, okay.
And then to get deeper in specific industries, they picked up Card Free. That's an integrated platform for hospitality. Think hotels, restaurants. Expands what Clover can do there significantly. They even added money down in Brazil, focused on Latin American risk and credit solutions. So, well, Sam, too.
So buying global reach and specific industry tech, does that suggest they see acquisition as the faster path to scaling merchant globally, rather than just building it organically everywhere?
It certainly looks like a willingness to buy established market access, yeah.
Yeah.
Cuts down that time to market risk. But interestingly, they didn't forget the financial segment in their M&A plans either.
Right. What acquisitions were bolstering the financial side?
These felt very tied to the sort of future of banking trends. They acquired Payfair. Payfair does program management for things like instant earnings, banking solutions.
Embedded finance.
Exactly. This boosts their ability to offer embedded finance, where banking services get built right into non-financial apps. Big growth area. And they also bought SCG, Smith Consulting Group. They specialize in operational consulting, specifically for community banks and credit unions, so strengthening ties with that smaller client base.
Okay, so buying pieces for both sides, and while they were bringing companies in, they also managed a pretty major separation, right? The Wells Fargo Merchant Services JV non-renewal.
That was a big one. That joint venture, the WFMS partnership, it had been around for ages. It officially ended in April 2025. It was clearly a complex situation, probably expensive to unwind, but strategically necessary. It kind of clears the path. Fiserv got an initial cash payment of $453 million when it expired.
And we should remember they already took a hit on that last year, right?
Good point.
Yeah.
They recorded a huge pre-tax impairment charge back in 2024 related to this non-renewal, about $570 million. So this year's expiration kind of closes that chapter, financially and strategically.
Okay, speaking of financial maneuvering, they weren't just buying companies, they were really active in the debt markets and with their own stock. Let's pivot to capital strategy because, wow, the buybacks.
It's been extraordinary, hasn't it? 2 major senior note issuances this year. There was a $2.7 offering back in August, and before that, a massive $2.175 billion offering in May, Euro debt as well.
Huge amounts.
And it signals real confidence, I think, because the proceeds weren't primarily earmarked just for those acquisitions we talked about. It was listed as general corporate purposes, which included repaying commercial paper, but also, notably, funding enormous share repurchases.
Yeah, the sheer scale of the buybacks really jumps out from the filing.
It does. They spent $5.4 billion
Billion, with a B.
to repurchase 29.1 million shares of their common stock. And that's just in the first 9 months of 2025. That aggressive buyback program is a direct contributor to the 6% reduction we saw in their diluted weighted average shares outstanding.
Which, in turn, juices the EPS number we mentioned earlier.
Precisely. It's a key part of that EPS growth story.
They also locked in future flexibility, didn't they, with a new credit facility?
Yeah, a big one. A new $8.0 billion senior unsecured multi-currency revolving credit facility. Matures way out in August 2030.
$8 billion. That's a serious safety net.
It absolutely is. It ensures they have plenty of capacity to refinance short-term debt, like commercial paper, and just maintain flexibility for whatever comes next. More M&A, more buybacks, weathering storms.
Okay, speaking of storms and debt, we have to touch on a pretty jaw-dropping data point buried in the report. It concerns the financial risk they're managing internationally, specifically Latin America. When they use foreign lines of credit for merchant settlement advances, The interest rates get kind of wild.
Wild is putting it mildly. This really highlights the intense pressure on their international finance and risk teams. Look at Argentina. To fund those basic merchant settlement advances, basically, fronting the merchant cash before Fiserv gets it from the banks, the weighted average interest rate on those specific credit lines was 55.552% as of September 30th.
Wait, say that again? 55.5% interest rate.
55.552%, yes.
How do you even operate? How do you model risk when a core cost is fluctuating like that at such an astronomical level? That's hard to fathom in most economies.
It's a massive, massive challenge. And get this, that 55.5% rate, it was up sharply from 38.470% just 1 year prior.
Unbelievable.
It's driven entirely by Argentina's hyperinflationary economy, plus recent policy changes leading to currency devaluation. It just starkly shows that while we talk about merchant segment growth strategies, their ops teams are literally battling extreme macroeconomic headwinds just to keep basic functions running smoothly in some markets.
Yeah, that high-risk environment really underscores why they'd be focusing on consolidation, internal efficiency. Which brings us nicely to their big new strategic program, the One Fiserv Action Plan, launched last quarter. What's the focus of this multi-year undertaking?
Right, the One Fiserv plan. It sounds like a major transformation effort aimed at integrating all these acquisitions, all these platforms, more tightly. It's built around 5 strategic pillars, they say. The key ones really seem to be building that preeminent small business platform, which is code for Clover, obviously, and also creating differentiated financial platforms. They specifically mentioned focusing on embedded finance, which we talked about, and even exploring stablecoin technologies.
Interesting. And the engine to make all this happen, to achieve the integration and operational excellence?
Technology, specifically AI.
Ah, of course.
They're betting heavily on it. The report mentions delivering operational excellence via AI. They plan to use generative AI, agentic AI, both to enhance client solutions and to fundamentally improve their own internal operations. You can see how critical AI would be for integrating such sprawling global operations and trying to maintain or gain a competitive edge.
Okay, nearly there. But before the final takeaway, we have to mention a risk factor: litigation. Given how central Clover is to their whole growth narrative, any legal challenge there is significant. Fiserv disclosed a federal securities law complaint filed back in July 2025. What's the core allegation?
The complaint alleges that the company made misleading statements about Clover's growth trajectory, basically questioning how strong or sustainable that growth really was. Now, Fiserv states they'll vigorously defend a case, as you'd expect, but importantly, they did disclose a possible litigation exposure range.
Okay.
In excess of any amounts they might have already accrued, the potential hit could be anywhere from 0 up to $120 million.
0 to 120 million. That's quite a range.
It is. And given that the entire merchant growth story hinges so heavily on Clover, it's definitely a risk factor investors need to keep a very close eye on. So what does this all mean? Look, Fiserv is clearly operating in this fascinating, complex space. They're juggling serious macro pressures like that shocking interest rate situation in Argentina while simultaneously making these aggressive forward investments. They're generating solid growth in revenue, even better growth in net income. But that growth, particularly on the merchant side, it's coming at a cost. Higher residual payments are eating into margins there, and their response: targeted M&A for global reach, especially for Clover, fueled by debt and coupled with absolutely massive share repurchases. The strategic pillars seem clear. Clover expansion and the new AI-driven One Fiserv strategy are central.
Yeah, the strategy definitely feels like a high-wire act, balancing rewarding shareholders right now with funding that longer-term vision. If you look again at the capital expenditure numbers, that's their direct investment in things like property, equipment, capitalized software. That totaled about $1.3 billion year to date.
Okay, $1.3 billion CapEx.
But they spent over 4 times that amount, $5.4 billion, buying back their own stock. So the final question, maybe for you listening, is this: given that huge allocation towards buybacks compared to the direct investment in CapEx and funding that big One Fiserv AI transformation, how will that balance ultimately shape the future? The trajectory of those two core segments, merchant and financial, heading into 2026, does prioritizing immediate shareholder returns, risk potentially underfunding the very complex long-term tech dominance they seem to be aiming for with this AI-driven plan? That tension, capital return versus future funding, that feels like the real story embedded in this quarter's numbers.